Very well, welcome to everyone. Just give it a couple more moments for everyone to have logged in, settled down to their lunch, and hopefully the volume's working so you can all hear us and enjoy this afternoon's activities. Way of introduction, my name's Mitch Young, also known as Mitch the Taxman on social media, and I am the co-founder of the Fusion Consulting Group. It's a pleasure to be with you all today, whether you're joining us on our webinar software or live on social media. It's great to be with you in what is a pivotal moment in taxation. So today's webinar, we've themed the election special, and we're going to be talking about a number of aspects of what Labour may bring in, and of course, some tax planning opportunities. This is one of a whole series of webinars that we're going to be delivering for you, and we'll talk about the next set of webinars coming up in July and August and what they're going to be themed around as part of our summer special. Just as some housekeeping, there is some great facilities on our software today. There will be a chance for you to ask questions. So if you have any tax questions that myself or Henry may be talking about, there you can put them in the chat function, and also there's a Q&A section on the chat function as well. So please feel free to load up all your questions, and myself and Henry have dedicated a bit of time towards the end of today's session to answer your specific questions. And we'll also be running a poll midway through today's webinar. The webinar is likely to last around 40 minutes. We will try to get through as much as possible, but also not to bore you in what is no doubt your lunchtime, so you can have a productive rest of today. So I've already introduced myself. For those that want to get in touch with me personally, then my email address is on screen now, and of course ensure that you're following me on social media at Mitch the Taxman. My colleague has also joined me, Henry Smith Langridge, who is our senior US UK tax advisor and regularly works with myself on a number of high-end tax advisory projects and leads our US side of the business as well. So Henry's email address is also on screen for anyone who may want to get in touch as well. Henry, if you'd like to say hi.
Hello, everyone. Good to see so many people in attendance. And if anyone wants to ask any questions about the general election or anything else, maybe football related, feel free to drop a message.
Yeah, I wouldn't advise asking Henry anything football related. So just as a way of background, my company, obviously we're best known for our expertise in the area of taxation, but what we've built here is essentially a professional private office. So we've got the in-house tax team, we've got the accounting team, financial advisory team, law, legacy, consulting, recruitment, CFO as a service, and international taxation. With the idea being that nowadays for a family, for a business owner, their matters are very complex. Tax finances are very complex. So by having all your key advisors in the same company working effectively will help you get exactly what you need in moving your business and personal circumstances forward, and of course ensuring that you're tax efficient. So we're one of the first of our size to successfully establish this professional group. And of course, it'd be a pleasure to speak to any of you about onboarding you and your family or your business in greater detail after today's session. So in terms of the agenda today, we've broken it down into 3 core components. The first is looking at the proposed tax changes. The second will be looking at tax planning opportunities. And the third will be a Q&A section whereby we'll be answering questions from the audience today. So I'm going to kick things off and talk about the taxes which Labour have said will not be changed, will not be raised. And there's 3 core taxes according to the Labour manifesto which will not be raised in the next budget. And they are national insurance, income tax. So the current rates of income tax at all 3 levels, basic rate, additional rate and higher rate, are not going to be affected. And of course, the main rates of VAT as well will not be changed. There will be a slide on VAT, an area of VAT which is topical in and around school fees a bit further on. So the taxes where in the manifesto Labour have said will be changed are as follows. And the big one is around non-domiciled individuals and how these individuals will be subject to tax. Currently, there's specific rules around if you're a non-domiciled individual who is resident in the UK. And for those that aren't too au fait with the terminology, it essentially means if you are living in the UK, but you may have been born in another country or historically have lived in another country and come to the UK, or potentially your father is from another country, then, and you're living in the UK, then you're classified as what's called not domiciled, non-domiciled in the UK. And historically, these individuals have been able to shelter their offshore income and gains from UK taxation. They've had a choice of how to be taxed. Labour have said they're going to remove this option, and subsequently these individuals are likely to pay income tax and capital gains tax on their worldwide income and gains, which is quite a major change. The specifics of this rule change have not been announced. It will be announced in the next budget, but we know that this tax rule will be abolished. This also links into the next point here, which is around the end of offshore trusts to avoid inheritance tax. So historically, one could put assets into an offshore trust, and because that trust was offshore, it wasn't subject to UK inheritance tax, essentially. So Labour want to and will be removing this. So what we're seeing practically in the tax world is a lot of these structures now having to be unwound. So these are legacy structures which were set up many years ago in a complex tax strategies, and now they're all having to be unwound. So if you do have an offshore trust, it's very important you seek immediate tax advice. There's going to be a rule change to the carried interest rules. What essentially this is referring to is a lot of private equity companies have essentially claimed capital gains tax rates on some of their distributions, i.e. income from carried interest on investments. So they would essentially pay either 10% or 20% on some of their income. And now Labour want to change that and say that actually is income, so it should be subject to income tax, not capital gains tax. Furthermore, they've announced a permanent full expensing system for a capital investment in businesses. This essentially means there be an annual investment allowance every single year available to businesses to help them reduce tax and corporation tax. And finally, what was announced in the manifesto, and they're going to commit to enforcing this in the budget, is a further additional percentage on stamp duty for purchase of residential property for non-UK resident individuals. So this is another blow to non-UK residents who want to invest and purchase into the UK market. We will go on to talk about what we predict as well might come in the next budget. The budget has been announced for September time, so they are bringing that forward a lot earlier than the traditional budget. I don't believe there's been an exact date that's been set for September, but it's likely to be in and around the middle of September. And whether they enact any tax rule change immediately or they phase some in come April, that will all be planned out come September time. So what we'll talk about as we progress through today's webinar is this window of opportunity. So I'm now going to hand you over to Henry, who will talk you through the next few slides before handing back to me.
Rich. And just to kick things off, I thought I'd start by talking a bit about VAT on school fees. So as most people know, especially the parents who send their children to fee-paying schools, Labour are talking about introducing a VAT 20% on top of those tuition fees. So effectively making it more expensive for parents to send their children to fee-paying schools. Now, the irony behind this policy is that it probably will impact more of the not so well-off people, but definitely the people who maybe are sending their kids to perhaps a local comprehensive and want to ensure that their children are getting the best possible education. So this 20% effectively tax on top of that can be a real game changer for parents. And Rachel Reeves, who's the new Chancellor of the Exchequer, has said that they will probably not introduce any changes for boarding or day schools until next year. So if your kid's in school at the moment or they're about to break up for summer, you'll probably fine until next year. In addition, we noticed a lot of parents around sort of the second half of last year coming to us. Effectively, a lot of schools, perhaps you may be one of them, but one of the schools were offering these one-time payment options. So effectively, you're prepaying for future years with that school, so that if you pay it now, the idea being you won't pay that VAT later on. Now, it's a bit of a open season with schools at that time because they're effectively getting 3, 4, 5 years of school fees paid for in one go. With no particular discount other than not having to pay the VAT when Labour decides to introduce it. So another key issue we've seen is that perhaps that won't work. Perhaps maybe Labour will change the rules so that these are arguably more advanced payments, or rather deposits, and are therefore subject to the VAT when they introduce this VAT on tuition fees. So I think the key theme here is they're going to definitely look to try and close as many loopholes that existed. So that includes those prepayments. In addition, you may be someone, perhaps you've heard of the grandparents paying for fees. That was something that we also used to hear a lot. Again, Labour committed to trying to close down some of those obvious loopholes. So effectively, if you're sending your kid to school and there's a fee, you're probably going to be subject to this VAT. If not this year, then perhaps next year. So something really to be mindful of. And for a lot of people who are particularly in that sort of middle income tax bracket, I imagine that's going to be quite a big change in your cost of living. In addition, inheritance tax. This is probably one of the most unpopular taxes that exists because you're talking about death traditionally, although not always. When we advise clients on inheritance tax, this is always something where we need to be very mindful because a lot of people tend to get to retirement before they start thinking about how to structure their estate and how to efficiently give away assets so that they do not end up with a great big 40% inheritance tax bill when they die. However, a lot of changes could be made in the next few years, maybe if not in the first budget, perhaps in a later budget, just changing some of the rules about how business assets, certain business assets get taxed, agricultural assets get taxed, and specifically in relation to lifetime gifts. Now, what that means is normally under current legislation, if you give away an asset to your children and you live 7 years, usually there's no inheritance tax to pay. So that's 7 years, perhaps they can look to increase that. So maybe 10 years or perhaps increase the amount of annual exemption you can give. So that's effectively how much money you can give every year without that becoming a considered gift for inheritance tax purposes. And there will probably be a big change without any consultation. And inheritance tax overall doesn't tend to raise as much revenue as one might assume. So could be, minor tinkering involved and could potentially increase over time. And bear in mind as well, just one point to make on this, even if Labour doesn't necessarily increase inheritance tax, the nil rate band has been frozen since 2009. So even just not increasing the rate bands is going to potentially increase your inheritance tax bill as inflation takes effect. Capital gains tax. Now, this is something where I want to really highlight to everyone because this is something that was specifically absent from the Labour's manifesto. And what that means is they did not say they weren't going to increase this. So I think a lot of the speculation, particularly in pretty reputable newspapers, is that capital gains tax is likely going to align itself more with income tax rates. So for those of you who don't know, if you sell something, you make a gain, you pay capital gains tax. Usually it's about 10 to 20%, as Mitch said earlier. And if you have a job and you earn an income, you could be paying up to 45% tax on that. So looking to align the capital gains tax rates with income tax rates to effectively make it so that people who make money from earned income pay the same tax as people who make money from unearned income. So what a lot of people and a lot of our clients are doing are looking to sell down assets to effectively rebase their portfolio. So effectively, a bit like the VAT point earlier, taking the hit now, knowing what their exposure is, paying the tax at 20%, and then potentially if it increases to 40%, well, you're not going to be subject to that 40% above what you rebased it at. So effectively a smaller portion of your asset appreciation is subject to capital gains tax. Now, whether or not you should do that is a purely financial decision. Speak to us if you're not sure. Of course, we want to make sure if you are rebasing, you're filing your tax return and paying the tax on that amount because you're sort of hedging on the fact that it may increase later, which if it doesn't, then that's a different conversation. But Labour have ruled out introducing CGT on private residence, which I think a lot of people were particularly worried about. Normally, if you sell your house, you don't pay capital gains tax, and that's probably going to remain the way it is.
Yeah. We're just going to run a poll now. So hopefully you can just see that on screen. No. Can you see the poll? People go.
Yep, you can see some people.
Okay, we've just got a poll where we're just interested to know your thoughts on whether you believe capital gains tax will increase or not. So if you'd like to just click the poll for a few minutes, we'll just leave that on, and then we'll share the results with you at the end of that poll. Thank you.
I've seen some questions coming in. Thank you everyone for putting your questions in the chat box. I just think whilst they're doing that poll, I'll just quickly answer some of these. When do we think the next budget will be? Well, typically we have 2 budgets a year, one in spring, one in autumn, and usually it's about sort of October time. So the first budget could be in a few months, although they don't always have to follow that convention. They could do it sooner, but generally it will be towards the end of the year. Obviously, leading up, the spring one, the March one is the big one, because that is what predecedes the start of the tax year. So that will be where a lot of big changes come into effect.
Okay, so I think we've got the result of the poll, so we'll just look at that and then you can move on to the next slide. And we are answering questions at the end, so those of you who have joined a bit late, please feel free to write your questions in the chat box, the Q&A box, or indeed on my social media comments on the live stream. So the results of the poll, we've got 91% of you think that capital gains tax will be rising under a Labour government. So in line with our thinking. So that's good to know. All right.
Watch this space, especially if you're an investor. That's something we're going to need to really advise carefully on, because I think there's going to be a lot of I imagine a lot of people panicking trying to sell before any announcement comes in. So we're just going to move from capital gains tax, talk a bit about pensions. Now, pensions, every time there's a change in government, every new government loves to tinker with pensions. It's one of the more fiddly areas of the tax code. Broadly, when, as most people know, especially if you're either in drawdown, you've started taking money out, or indeed you've taken your lump sum tax-free out of your pension already, some of the rules about how the lifetime allowance works has changed and been abolished. Labour now, currently, if you can put up to £60,000 a year into a pension. It used to be £40,000 a couple of years ago. So the amount people are putting into pensions could decrease back down to that 40,000. Furthermore, the inheritance, generally your pension is inheritance tax exempt. So what that means is when you die, you do not, the value, if you have £1 million in your pension, that does not go in your estate. So you do not pay inheritance tax on that amount. That could change. We could see that perhaps be brought into your estate. And of course, if you're looking at 40% inheritance tax, that could be a real chunk of change in your pension that's suddenly subject to tax if you die. Now, pensions generally for higher and additional rate taxpayers, so that's people who pay 40% or 45% income tax, those people, when they put money into the pension, it costs them less to put the same pound into a pension due to the fact that they get more tax relief from the government if you're a higher additional rate taxpayer. So what that means is when you want to contribute to your pension, if you're a basic rate taxpayer, there's not as much tax savings than if you're a higher additional rate taxpayer. So they could look to potentially level the playing field. So it doesn't matter if you're earning £20,000 a year or £150,000 a year, the same pound that goes into the pension is worth the same to everyone, so that the effectively higher earners are not so penalised. Although bear in mind, pensions are not all great if you earn a lot of money, because eventually you start to lose your annual allowance with the tapering. So it's a bit of a careful balance, but especially if you're someone who's approaching retirement, considering putting money into a pension, this is something to be aware of and something to definitely get some considered tax advice on. Mitch, I'm just going to pass back to you. Mitch is just going to talk a bit about trend alerts.
Okay, yeah, so thanks everyone for bearing with us. I think obviously we've been through the key points outlined in the Labour manifesto, because those are the changes that will come in, and we fully expect there to be some surprises in terms of the budget coming up in September. So what this is creating is a window of opportunity between now at the beginning of July and the middle of September to take advantage of the current tax rates, to take advantage of the current rules, reliefs, allowances that are there. We're already predicting, as are the majority of experts, tax and financial experts, that capital gains tax will be rising. Whether it's going to be rising in line with income tax all the way, or whether it's going to be a phased approach, or whatever it may be, there will likely be an increase in capital gains tax. Furthermore, we don't know fully what changes are going to be made in inheritance tax. We do believe there will be some subtle changes to certain rules can be outlined within the inheritance tax relief as well. And of course, non-domicile and offshore trusts, as I mentioned. So what we need to do now is take advantage of today's current set of circumstances. And we're seeing a number of our clients look at rebasing their assets, look at selling their portfolio, look at gifting their portfolios. When it comes to gifting and inheritance tax, this is one of the examples when inheritance tax and capital gains tax interlink. So if you're talking about a family, if you're talking about shares of a business coming down to your children, if you're talking about assets going to other family members, friends, this is where inheritance tax and capital gains tax, and of course stamp duty, all interlink. So this is why it's so imperative to look at the planning now. Some of the trends in what we're seeing is around structuring of a family company, of a family legacy position. So this may be trust work with a corporate structure underneath it. The benefits of that is that we can take advantage of corporate tax rates. This is one of the rates which won't be increasing in the next budget. Sheltering your investment and income strategy at a corporate tax rate level, whilst sheltering the gains and working on inheritance tax provisions. It is really now or never in terms of that complex restructuring of whatever you have going on in order to be efficient before the rates start rising, either in September or come April 2025. So family investment structures, intergenerational structures between your parents, coming down into a family corporate structure. And by that, we mean, a family holding entity which owns the shares. Then that holds the shares in potentially your trading business, your property co, and anything else. So we need that agile tax work. We need to understand the options, and then we need to take advantage. An area which is coming up more and more, and we've seen some questions already on this today, and some comments, and myself and Henry deal with these queries every single day, is about, well, the UK seems a bit of a bad place right now in terms of tax. What and how can we set up overseas? Are there going to be any changes to how that works in terms of taxation? How does an overseas entity come into my structure, and how do we make that compliant? What is the double tax treaties in place between now and wherever it is you may be thinking? More often than not, the UAE comes up and we look at planning around residency. We haven't really touched about the current rules of residency. There hasn't been any, notes in the manifesto about the current statutory residency test or the rules around that. But that type of planning is, it should be looked at. It's not as, in terms of if you've got the appetite to do that, of course. If it's not as simple as just setting up a company overseas and just running that business from your home in the UK. It's, there's loads of anti-avoidance provisions in place, but ultimately for the right family, for the right business, you can set up an offshore company within your mix, if you like, and follow the rules, and that could be an option as well. We've spoken about selling of assets. I don't particularly need to go into that, but of course, more and more property investors are struggling with the latest tax changes and the latest Labour changes to Section 21 and everything else. So it is going to get harder for property investors and landlords to operate in a smooth environment and tax efficiency. So again, what can be done? We're looking at partnerships. Are you in a partnership? Why is it important to be in a partnership? We may look at the different rates, income tax bands between you and your partner. We may want to look at a long-term strategy in commercializing your partnership into a limited company. There's been some off-the-market tax planning methods around the use of a partnership. There's been a lot in the media about it in terms of artificially creating a partnership for the use of tax planning, which of course is not good, but for the right person, partnerships should be looked at. So these are some of the things that we're seeing in practice, and more we're looking at the older generation, probate to inheritance tax, and then coming down to the next generation. It seems that a lot of the older generation might have left tax planning to the last minute, and that next generation, I don't know what you call them, XYZ, EFG, is picking up the pieces, and they're more au fait in terms of what should be done from a tax planning point of view. But we're telling you today to take this step in consulting with your accountant, with your tax advisor. You've got a couple of months left before significant tax changes come in. So essentially, and as I'm speaking, questions, keep putting them in the chat. We've only got one more slide before the Q&A, and you can start grilling us in. Oh, actually, a couple more slides. So I'm not going to talk again about this window of opportunity, but not only for tax is one component. We then look at the skeleton structures, then layer in financial planning, and then legacy planning. Of course, when we talk about financial planning, we're talking about your pensions, your ISAs, your investments, your insurances. Legacy, we're talking about overlaying that with a proper will, a trust, lasting power of attorney. It's important to get a plan. No one can tell you, I think you should do this because of X, Y, and Z. So only looking about 10% of what you've got going on in a siloed manner. We need to look at the interaction of every potential decision and different structure and options going through your mind, then analyze the tax and financial impact of those options, lay it all down for you so you can see in black and white, and that will enable you to move forward with peace of mind, knowing that you've got the right and efficient structure moving forward. It's too complex now just to say X or Y. You need an agile approach, a very detailed, dedicated plan to move forward and be efficient in today's world. So just got on screen now an example of our work. Not a lot of, I appreciate it's quite small, so you won't be able to read it, but not a lot of people know what tax advice looks like. So this is an extract of an element of what we call our foundation report, where on the left-hand side, we're looking at the tax savings before and after this proposed restructure. The middle section, we're looking at the different classes of shares into this and what it means. The right-hand side, we're looking at the availability of the tax reliefs of this planning and why we've applied them to your circumstances. So we'll agree a set of scenarios with you and then model out each and every scenario, analysing the tax, financial, legal impacts. And then once you have that big document, we then build up towards the master strategy, which we can implement in-house, or we can project manage or coordinate with your existing advisors. We're very agile and respectful of existing relationships, so you can use us how you want to. If anyone would like to speak with us, we always have an initial consultation. So that will be booked in by my colleague, and it will be with either myself or my colleague or Henry, and we will talk through your scenario. We will give you some options generically, And if we feel you need bespoke tax advice, we will follow that up with an email with our suggestions, high level, and what we would charge as a fixed fee to produce that project. So we are available all day, every day, all throughout the summer to work with you before the budget to help you. Okay, so please get in touch. Our contact details are on screen, and there'll be emails going out after today's webinar, or there'll be links in my bio on social media. We're fairly accessible. So I'm going to take a breath, and we will now embark in the Q&A section, of which there are quite a few. So Henry, if you want to whiz through some, and then I'll have a go once you've finished a couple.
Great. Thanks, Mitch. And yeah, if anyone has, I appreciate there's only so much detail you can give in a public forum, but if you have if any of you want to chat more, as Mitch says, and one of the questions is how much for the first consultation? Well, it's a no obligation call, usually about 20 minutes. We do not charge for that. So just to chat through your affairs and to really get a feel for you, because you may have some questions and there may be things that come up in conversation which you want to talk about. So no charge for the initial consultation. Have a chat, book it in, drop us a email, call, and we can get that booked in for you. But that was 2 questions there already done. We've already answered the question about the budget. There's a good question here, actually. Jatin, is Labour going to tax non-resident citizens on worldwide income? I think that's a really good question. There's always, every 6 months or so on the FT, you always see this article about should the UK tax its citizens as opposed to its residents on their worldwide income. Now, for anyone who doesn't know, the US has a citizenship basis of taxation. That means they tax their citizens regardless of where they live. They may not even be born in the US. They may have acquired citizenship through their parents, and they've never visited the US. They would still be subject to US tax on their worldwide income and gains. Now, that doesn't necessarily mean you're going to pay tax twice, because there are things like double taxation agreements. So if you live in the UK, you generally don't have a tax liability if you're also in the US citizen. So probably not, although Australia is now talking about introducing that. So it's potentially on the cards, but I don't see that happening anytime soon. And besides, it's a very unpopular policy, and Labour has plenty of bigger fish to fry, so it's probably low down on their totem pole at the moment. This is another question in relation to school fees and VAT. If you have a presumably limited company, VAT registered, and the business is paying the school fees for your child or grandchild, are those deductible expenses, presumably for corporation tax, and can you get the VAT back that way? Now, the answer is probably no. So you don't generally get the VAT back, and you don't get the corporation tax deduction. If your business is selling widgets and you put your children through a fee-paying school and there's a VAT on that, you generally can't use your company to piggyback off of that. But there are other ways you can look to structure that so that you can get a more tax optimal outcome for paying those fees without necessarily just putting it through the company and trying to reclaim it that way. Because at the end of the year, you're probably going to find your accountant or tax advisor doesn't allow you to take those expenses. And also you get the benefit in kind tax without getting the corresponding VAT back. So it ends up just putting you in the same position it would have put you in had you just not done any of that in the first place. So good question here about the entrepreneurs relief, what's now called business asset disposal relief. That's something that we do need to, Labour has specifically said that they are not so keen on, because if you sell a business, let's say you've been really successful, you sell your company for £1 million and it's your company, so you probably have no base costs, you've made a pure gain of £1 million, you can pay capital gains tax currently at a reduced rate of 10% under business asset disposal relief. Now, HMRC and has been in consultation for a while to try and incentivize growth. So if you're a startup, trying to incentivize growing that business, because if you've been uber successful and you're making millions of pounds on selling your company, the idea is well, you've already made a lot of money, so what is it to you if you have an extra 10% capital gains tax to pay on that disposal? So probably will be something to look at, but not something that is, again, Labour have specifically mentioned. And plus, if income tax rates and capital gains tax align themselves, then business asset disposal relief, entrepreneurs relief will probably also potentially be abolished. Is there one more question, and I'll just let Mitch answer some as well, but another one here about, is there, about offshore trusts, can we use offshore trust counteract IHT? Now, generally, trusts and tax are very complicated, and I think, maybe 40 years ago, everyone was very keen on trusts as mechanisms to pay less tax. Unfortunately, trusts nowadays aren't necessarily zero tax options. So that doesn't necessarily mean you're paying more tax by using one. It just means that you could potentially lower your tax exposure by using a trust, but you need to be very careful, because George Osborne a few years ago changed the whole landscape about trusts, and they are normally never amazing options for everyone. So you do need to be quite careful when using that. Although as part of our analysis, we work with a network of international advisors who specialize in these things. So we have that knowledge and resource to know when it is and isn't a good option for a client.
Okay, yeah, thanks, Henry. Good shift. So yeah, a few. I'll just answer a few just to finish up. So there were a few questions about, is the webinar being recorded? So yes, it's being recorded, and if you've registered, you'll get an email tomorrow, I think, with the link to the recording, so you can watch this over and over again and enjoy our subtle tones. Let's just answer a few more. Can you give me an idea of your cost for advice on a one-to-one basis? We're already working with accountants and tax specialists for restructure. However, we'd like a one-to-one approach for the partnership. So yes, I mean, essentially what we typically would do is just have a chat with you, understand, what exactly is going on and what it is required. And then most likely we'd agree a fixed fee for our involvement. We don't particularly like doing hourly fees. So, most of the time we work on a fixed fee basis. And as Henry said, it's always the first consultation is always free. Do we know the percentage for corporation tax and the amount of tax-free dividends will change? So they've said that corporation tax will remain. There won't be any changes to that at the 25% level. So that's going to be the same. The tax-free dividend amount, that possibly could change. It's one to look out for in the budget. Questions coming in about IR35, so which will be interesting to follow and look at the progress of that. I believe IR35 was a Labour, incentive or policy. So yeah, be interesting to see if there is going to be comments and changes on that, which I suspect there will be, given it was their idea in the first place. So it will be interesting to follow the progress of that over the next couple of budgets, most certainly. We've been inundated with questions, so I think what we'll do is we'll work offline to answer and respond to as many of these as possible. But we'll be here all day if we have to answer all the questions. But appreciate obviously everyone's input into today's questions. Obviously, as mentioned, we're more than happy to hear from you all. So if you do have a generic question or want to chat to us, just get in touch. Email us or get in touch one way or another by responding to our marketing, and we'll be delighted to work out if we can help you or not. So this webinar was part of a summer series that my organisation Fusion is putting on for you, all free of charge. This is the third out of 5. We do have a couple more. The next one is on the 25th of July, which we focus around financial advice. corporate staff benefits and having all that explained. Really important in today's world to keep staff happy. And then in the beginning of August, a great one from our accounting team is 5 things your accountant should be doing for you, but probably isn't. So that's going to be a great one. So if you are around in August, make sure you sign up for that. A lot of comments I get is that, you know, your accountant's not being proactive and all that type of stuff. So our accounting team will be hosting that one. You can sign up. All our marketing is there. So yeah, the team, our financial and accounting team, will be hosting that. But for now, I appreciate your time today and investing that 50 minutes with myself and Henry. Hopefully you've enjoyed it. It's always good to hear your feedback. And as I've said, we've got between now and September to significantly help you become more tax efficient. So don't delay. Get in touch with us today. Thank you.
Thank you, everyone.